Hi there and welcome to Stock Club. I'm Mike, and during today's episode is MyWallSt's chief investor, Emmett Savage. We've spoken on the podcast before about cloud-based unified communications. Basically, it's a technology that integrates various communications and collaboration tools into a single system. These tools typically include voice, video conferencing, instant messaging, email, file sharing, all that good stuff. Everything we use in business, basically. According to a Covell Group report, cloud-based unified communications penetration in Ireland is currently at 44%. That is expected to double in the next 5 years. So as it happens, our friends at Vodafone Business Ireland and Ring Central, which is also an NYSE listed business, announced the launch of Vodafone Business UC with Ring Central for organizations of all sizes in Ireland. This is huge for business. Already available in Italy, Spain, Portugal, Germany, and the UK, this solution allows businesses to facilitate seamless communication and collaboration from virtually any device, anywhere, at any time. With this offering, Vodafone Business Ireland and Ring Central are helping businesses adapt to the evolving landscape of hybrid work. Now, let's dive into today's episode. Emmet, how we doing?
Bonjour, Mike. Comment ça va?
Oh, très bien, mon ami, très bien. Actually, my last week in France. Heading back to Ireland next on Saturday for a bit of the summer, so it should be a bit of crack.
Yeah, and a bit of rain as well. Northern France, west coast of Ireland, I think their climates are very similar, but I think you have a slight edge in northern France, but you can't chase the weather, can you?
No. How's that with you?
Well, very well, actually, yeah. Enjoying the early days of summer. Well, it feels like the early days. It's actually the middle days of summer, but over here in Ireland, it still feels like the early days of summer because people are only wrapping up now. As you well know, the leaving cert and junior certs are wrapping up at the moment, and that means that families are getting ready to take their annual summer vacation. So it feels like it's only just beginning now. So there's a nice kind of atmosphere in the air, and I think I can see, even internally in my Wall Street projects, some projects are going to have to take a 1 or 2 week moratorium because the key people are gone away. So
I feel like everything was ramping up there for the last, well, I'd say 6 months, so a break wouldn't be the worst thing in the world.
No, that's for sure.
Yeah. Okay, before we get into today's show, you wanted to do a little sneak peek to start us off.
Oh yeah, let's start with the sneak peek. We're kind of jumbling things around. I just don't like breaking the flow at the end. So Nexus, as you know, Mike, as you and I were heavily involved in this month's, is publishing a stock that I believe in all likelihood I'm going to buy for Horizon portfolio, because we're about to discuss today companies that are what was the subject you said? Companies that are going to least suffer from AI disruption. Was that what you said?
Basically, yeah. So the theme of today's episode, you mentioned it last week when we were talking about Apple, and I've heard you say this a lot over the course of working in MyWallSt, is can this company be disrupted by Apple if it decided to steer into that industry? It brought on another more interesting conversation, I feel, which is AI now has become that as well. Can this company's business model be completely disrupted by AI tomorrow? And so the theme of the episode then was just finding a couple of stocks that you believe that you would hold for the long term that won't be disrupted by AI.
You're dead right. No, that sparked my memory, because you're right. Back when I used to say, look at FANG, an outdated term, but Facebook, Apple, Amazon, Netflix, and Google, 2 of those companies have since changed their name. Look at FANG.
I'd say FANG is just as appropriate. Just swap Netflix for Nvidia and you're okay.
Oh, that's true. Actually, very, very true. Well, I think now as you said, we can now look at AI as the great threat, our booster rocket for businesses, and so on that subject, the stock that's going to get published to Nexus today actually was discovered after reviewing every stock out there that has been called a baby Berkshire or a mini Hathaway or the next Berkshire Hathaway or any variation of that term in any publication for the last 3 years. And you just couldn't believe how many have actually been hit with that label by credible publications ranging from the Wall Street Journal to New York Times, The Economist. So a lot of businesses in one way or another have been called a baby Berkshire, if you like. And we are publishing a stock today in Nexus that is a founder-led business. It's growing through acquisition in a very specialist field, a field that has been required since the dawn of commerce and will be needed until the end of business itself. And I think it's an incredible tiny company that could 10 to 100x in the next 10 to 20 years. And I almost certainly am going to buy it post publication, and it just is just a wonderfully boring business that is doing something that I don't think AI is going to disrupt. So that's the sneak peek coming this week. In fact, today, Thursday, the 20th of June.
Very nice. Okay, so we've run through the structure of the show just to give it a bit more. We're moving away from just the newsy bit for this week, so if you're looking for updates, maybe this isn't the one. But we've got 2 stocks each, and we're going to give 3 reasons why you invest in this company, and then one kind of what could go wrong risk analysis at the end. Does that sound good, yeah?
Sounds good. I'm ready. I'm locked and loaded. I've picked my 2.
Yeah. All right. So your first company is Intuitive Surgical. I'm very interested to hear about this. It's a company you talked about a lot. So what's your number one reason for investing in Intuitive Surgical?
Well, I think I might, for the sake of our listeners, because I'm aware of the other stocks we're going to discuss, I'm just going to give a very quick 30-second on what Intuitive Surgical does. It's a $150 billion robotic surgery giant, US business. It's been around for quite some time. In fact, I remember in March 2009 sitting with my friend who's a surgeon, Mr. Philip Brady, one of the best surgeons in the country actually, and we were sitting in town in Davy Burns. I remember saying to him, I think we should buy shares in Intuitive Surgical, and at the time it's kind of split 3-1 on 2 occasions since then, and it's been a massive mega winner in the world of stock investing, and yet it still feels like it's in its infancy, and it's just a giant, probably the biggest med tech or robotic business. It is the biggest med robotic business out there, and it specifically has a giant robot called the Da Vinci Surgical System, which if our listeners haven't seen, they should jump on the internet and look at the Da Vinci Surgical System. It's kind of like a cockpit that surgeons sit into. The patient is on the operating table, and this futuristic set of hands act on behalf of the doctor, who controls with joysticks and has haptic feedback and can look into a screen inside a room. And in fact, actually I'm digressing here, but Arthur C. Clarke predicted Intuitive Surgical way back in the 60s, where he said someday surgeons would be able to operate on patients from the other side of the world. So it's most famous for robotic surgical systems, specifically its Da Vinci Surgical System. So the number one reason that I think people should take a close look at Da Vinci, say Intuitive, is that it is going to launch its Da Vinci 5 robot, which is almost certainly going to accelerate revenue growth, not just increase revenue, but accelerate it. The new system is priced about 30% higher than the last Da Vinci robot, which I think was called the Da Vinci... Strangely, I think it was called the Da Vinci 11. It's an XI, right? So to me, that's an 11 in Roman numerics. But the new machine is called the Da Vinci 5, so I'm just going to call the old one, right? This new one is 30% more expensive, and I presume its parts are more expensive too. So Da Vinci runs a razor and blade business model, which a lot of our listeners know refers to a pricing strategy where a company sells the primary product, which is the razor, at a slightly lowish price, and then generates high profits from the sale of a company, or from, complementary consumable bits or the blades for the lifetime of that product. And anyone who's ever bought a Gillette product over the years knows all about it. You go in, you buy a Gillette razor with 3 razors, you go, that's good, that's €5 or $5, and then next time you have to go in and there's an armed guard protecting the it's like, excuse me, can you unlock the case for me to get blades? So this is the razor and blade model. So the Da Vinci
on a much bigger scale now. We're talking about
on a way bigger scale. A pal of mine,
7 figures outlay. Yeah.
I don't know actually how much the last robot cost, but I do know a friend of mine whose mother is the CEO of a hospital, and he just said in passing to me that she was writing €1 million checks for the Da Vinci robot. Now, there could have been rounding for the sake of conversation, so I have in my head to buy the system and get it installed is about €1 million. And this new robot, the Da Vinci 5, includes lots of real genuine innovations that are going to be valued by surgeons and patients, like force feedback technology, which is, I'm pretty sure, is haptic by another name, but they're calling it force feedback, and it enhances the surgical capabilities where the surgeon feels, if you like, what's going on with the patient, which is another sensory extension of the skilled surgeon. and I presume is going to drive greater adoption. And the 17% year over year revenue that was increased in Q4 of 2023, which was the last quarter, indicates a really strong demand for the DaVinci 5 that the DaVinci 5 will capitalize on. So reason number one is a new, better machine coming out by the kingpin in a big industry.
I love that. I love any kind of razor and blade business model. I think they're so efficient, especially with something with such a big initial outlay. I almost think the razor and blade analogy doesn't do it enough justice, because when we ever see a really successful version of it, that initial razor, we'll call it, is this really expensive piece of machinery. Do you know what I mean? It's not a throwaway disposable razor, which probably back in the day was more expensive purchase. But you're so locked in. You are. We're talking about a million euro purchase for a hospital. So the consumables, it's almost non-negotiable. You can't stop using that machine. You can't switch. So that's why the business model is so beneficial to stocks. Okay. Number 2 reason for investing in Intuitive Surgical.
Well, companies that consistently invest in R&D tend to be more innovative, as you would expect, and you'd hope, you know,
it'd be a real issue if they weren't.
Well, they bring new products to market and they improve existing ones, which is evident by this new DaVinci machine, and that, of course, as I've already said, leads to higher revenue growth and ultimately trickles down the funnel to an improved stock performance over time. But one credible analysis I found online, but I don't have here in front of me, said that the leading medtech companies are ones that have had way higher R&D expenditure as a percentage of revenue, and they have outperformed their peers from a stock returns perspective. In other words, medtech companies that are investing in R&D outperform the others as an investment, which is really why we're here. So on that point, intuitively has significantly increased R&D spending from about $160 million in Q1 2021 to about $260 million in Q4 2023. So revenue in the most recent quarter was about $1.89 billion. So their R&D, Intuitive's R&D intensity, which is the R&D spend divided by revenue, was about 14%. Which is really good. This business isn't just virtue signaling and R&D, it's really ploughing serious cash in, with $250 million being the latest number. So this business isn't sitting on its laurels or resting on its laurels. It's actually going for it, and it's not. And I'm sure the DaVinci 6 has been conceived, and possibly the DaVinci 7. And that's what we see with these businesses. They're now building out their runway. So we're not just investing in this DaVinci 5. We're investing in the DaVinci 6, DaVinci 7, DaVinci 8. We're really investing in a business that already has a product pipeline conceived.
Absolutely. And when you think of returns on capital, whether it be return on equity, it's this metric we talk about a lot, of return on invested capital or return on capital employed, whichever one you kind of think of. Businesses all need those reinvestment opportunities. So for a company that, like Intuitive Surgery, that is making billions in profits, how do we invest that money back into the business to make more profits next year and the year after and the year after? And you talk about research and development and the DaVinci 6 or 7 or whatever it's going to be called, the XIII or whatever. That's a perfect example of a business that has tested reinvestment opportunities within it. That's really, really important for a business, especially once they mature to a level where they're taking in serious profits and serious cash flow. So
it's true.
Obviously a big. Do you have figures for the returns on capital?
I don't have them to hand, Mike, and I didn't commit them to memory, but they have good return on capital. I'm going to guess, and literally is a guess, that is between 15 and 20%. What would your guess be?
I'm literally have Finchat up here now for a second. Give me.
Okay.
Number 3 reason for investing in Intuitive Surgical.
Well, this is my favorite reason, actually, Mike. And
saving the best to last. I didn't do it that way, but okay.
Actually, because it's the big picture. It's that the robotic surgical market is still in its infancy, and Intuitive, as I said already, is the kingpin. Grand View Research, which is a research company, as its name suggests, predicts that the compound annual growth rate for the actual industry is going to be about 10% from 2024 to 2030 for a surgical robot market. And then Precedence Research, which is another house, projected a CAGR of about 16.4% all the way through to 2032, which is the higher end of predictions for growth in the market. And that basically says the market could reach about $37 billion by 2032, which is 10 times its current size. So we're looking at a business that is the kingpin in a growing industry, better products. It's the Coca-Cola, if you like, of the robotic surgical industry, and that industry is going through a period of massive growth. And if you don't know somebody at the moment who has had surgery from a robotic assisted surgery, in all likelihood in the next few years you'll have heard of somebody, or possibly some of our listeners will have experienced it already.
Brilliant. And I just checked it there. They've had the 5-year average of 20% return on invested capital. So
that's awesome.
It's pretty good business right there. If you put in €1 at the top and 120 comes out at the bottom over the last 5 years, you're doing well. Okay, so we're going to finish up. We can't really give an investment thesis without saying what goes wrong as well, or what could go wrong. So what are the kind of risks involved in intuitive surgical investment?
Yeah, you're dead right. I mean, the risks to any business are relatively similar, no matter what you look at. No matter what the business, there's regulatory risks, competitive risks, business model risks, key personnel risks, and all that stuff. Of course, every business has its own specific risks, but at 40,000 feet, they kind of all look the same-ish. So I think Intuitive could find some erosion in its opportunity from new entrants that offers something different, something smaller, cheaper, possibly more technically advanced, and so on. And in fact, on that, I recommended and bought a stock on Horizon with plans to do just that. It's an upstart, and its shares are actually in the toilet at the moment. But if it pulls it off, as it were, it's a 100-bagger in the making. Plain and simple. They are out to really eat a small part of Intuitive's lunch, but the business is so small at the moment, and they have a beautiful set of products that are just going through the FDA sausage machine. And once they're out the other end and they hit the road selling, if they deliver partially to the promise, they're going to grow like gangbusters. So I think companies like that and many, many others that are well capitalized are probably the bigger risk. But when I look at all the other risks, I really think they have a vast moat to their business, Intuitive. Like, it's technically complex. Selling is complex into hospitals. The service and maintenance and upgrade is complex. Like, it's a complex business, and they are the name. There's not a surgeon in the Western world, at least, who hasn't heard of Intuitive and a Da Vinci robot.
Brilliant. Okay, that's a great stock to kick us off.
All right, so over to you, Mike. Let's swing the microphone your direction, and you're going to kick off with Copart. Can you give us some background on the business and the number one reason you'd invest in it?
Yeah, so if anyone has been listening to Pod recently, they kind of know about my love for this company, but for new listeners, we'll say I give a small bit of background. So it's the world's largest seller of vehicles for salvage, basically purchases damaged cars from insurance companies or whoever else, banks, dealerships, whoever kind of claims a total car, remarkets them for salvagers and scrapyards throughout the world. It takes about roughly 20% of each transaction made on its auction site, and it's got the world's largest auction site for this salvage materials. I think the number one reason for Copart has been around for the last 40 years, and it's this very enduring tailwind that's kind of been there for the whole time of its success, and it's this ever-growing probability of a car totaling after a crash, so being written off, basically. So as modern cars add more and more electrical components, a car is basically a computer with wheels these days, so the chance of a car actually being totaled after an accident has increased 5-fold from 40 years ago. Now, it's very interesting because Copart has been a public company for 30 years and is up about 400-fold in that time period. Now, wow. I'm not saying it's the number one reason, but there is very, very intrinsically linked with that fact. Yeah. So, insurers are much more likely to declare a car totaled and auction on Copart instead of trying to make expensive repairs. So the company is getting much newer vehicles, less damaged vehicles. They're auctioning much more valuable assets, and hence that 20% commission it gets on every transaction is going up and up and up. The company's The company CFO, actually, Leah Stearns is her name. She came out recently with an interview, and she was talking about the average selling price of cars on Copart's on auctions. So I'm just going to read her quote out here. Our average selling price naturally has a base or a floor, and it's increasing as we're getting more and more units that are lighter, damaged, and inherently higher value. So over the last 10 years, we've observed the number of parts required to fix the vehicles increased by 50%, and the number of hours it takes has increased from 25 to 30 hours.
Wow.
So if you're an insurance company and you have this car that's doesn't seem like it's in bits or anything, but you look at the amount it's going to cost to fix it, the hours involved and all the rest, it really isn't worth it to you. So you send it off to Copart or wherever else. And that enduring tailwind has been around from the start of the business basically until now, and it's only getting stronger as well. Do you know what I mean?
Yeah.
Cars are becoming more and more technically advanced. It lends itself to EVs a lot too, which are known to be incredibly advanced tech wise. And then when you talk about EVs, and I'm going to talk about EVs a bit in the risks too, because it brings in a lot more question marks. But if you talk about an EV getting totaled because of the damage to, say, the electronic system, but the battery is completely intact, you've got an incredibly valuable bit of salvage to auction right there. It's huge factors why, and we're talking about returns on capital and all the rest, Copart's been able to maintain a revenue CAGR of 20% a year, while return on invested capital remains steady at 30% a year. That's over the last 5 years. So I think that, in my opinion, is the number one reason why someone would invest in Copart, because it's got this really secular tailwind that's not going anywhere. Do you know what I mean? If anything, it's only going to improve.
Yeah. No, it's a great one. It's a stock I just lament. It was in the original MyWallSt app, and too many times I looked at it and went, it's a little bit pricey, and now I'm like, this is an amazing business. And it's funny, we're talking about razor and blade business models. I wonder, are cars razor and blade business models? I mean, you buy an entry level car, depending on what market you're in, for maybe 20,000, whatever your currency is, entry level new car. Will you spend more than 20 grand in the lifetime of that car if you bring it all the way from the showroom to the grave in upkeep? There's no doubt you will, over the course of a car's lifetime. So although it's not a cheap product, and it's not something that the entry point is so low friction that it's actually the only thing you consider.
Yeah, it would be like if petrol companies started selling cars. Then
that's
it'd be
true.
Real razor and blade.
There's a car scrapyard not too far from where I live, and my sons were younger, we go down to have a look because it's like Disneyland for young boys. But and
go down with bats, just start kicking them out of it.
And it would always amaze me at what was written off. To your point, you just see cars that certainly cosmetically it looks like there's nothing wrong there. I'm sure the chassis was cracked or something, where an underwriter decided, no, not roadworthy, too expensive to fix up, and now if it goes to the car graveyard. And you can just see it's huge business. Okay, what's the second reason that you like Copart, Mike?
Okay, so this is a bit more comparative, I guess we'll say. So the two major players in the salvage auction market, so Copart and IAA. Between them, they control about 80% of the industry. So I mean, they're essentially a duopoly.
Yeah.
Duopolies are great for investors as long as everything remains above board. Like, just look at MasterCard and Visa, the two of the most successful stocks we've ever seen. Now, I don't know if the scrapyard market is a big enough one for the SEC to go after in terms of antitrust issues. I'd say we're probably in the clear. It's not like MasterCard and Visa, who obviously enjoy their own duopoly but have regulators up their hole the whole time. I don't think that's going to be the case with
a technical
Copart.
term, folks.
But what's nice about this duopoly, so you could say that MasterCard and Visa are very much on equal footing in general. You could make distinctions here and there, but in general terms, there's a parity. I don't believe there's a parity between Copart and AAA. I think one is very much higher quality business, and that is Copart. The first reason I'm going to keep in the holster for my third reason, I believe that deserves its own question, if that makes sense.
Right.
But if you
It
put
doesn't
Copart
make
in,
any sense at all, Mike, but we're just going to go with it.
well, we're just going to go with
We're
it.
going
I'm
to have to
talk
hear it and go,
over-
oh, that's what he meant.
I'm going to talk over people's confusion. But if you put Copart and IAA side by side, there's some pretty stark differences. And it goes all the way back to 2003, which is the year Copart decided to go fully online with its auction site. Now, IAA didn't make this decision until 2015. So that 12-year head start is very clear to see when we talk about scale and just the general networks effects that a marketplace has. So Copart has about 5 times the number of registered buyers compared to IAA. And like with any marketplace, the advantages scale brings becomes almost impossible to replicate. So if an auction facilitates the sale of, in Copart's case, 3 million vehicles per year, there's as much as 250,000 available cars or scraps auctions on site every day. That level of liquidity means it's going to be the first stop shop for buyers and sellers who will be able to have either more choice or the ability to get a better deal. And that's where the beautiful flywheel comes into effect with these wide scale network effects. More buyers gets more sellers gets more buyers, and on it goes. And because that leads to more options and liquidity for both, it just repeats this process again and again and again. And it's why when you have an established marketplace like that, it's so difficult to disrupt. And that's why I believe, while we're in a duopoly between Copart and IAA, I think I keep throwing an extra A in there every time I say that, IAA, Copart, in my opinion, has very clear advantages to IAA.
Let me ask a question. So, how do you engage with Copart as a customer? Like, imagine I was driving around America in my big old truck, and then suddenly you hear a clang, and I look, my carburetor fell out. That's not good. What next? How am I? Do I go online and just go to Copart.com, or do I, like, what is
your insurance goes to?
So it's B2B. I don't go in and go, hey, how you doing? Get us a carburetor from my big Ford GTA 452.
Yeah, I think as buyers, there's a lot of hobbyists and stuff that could go on and be like, I could go convert this, or I could buy these scratch parts or whatever else. But in terms of the sellers, most of the time it's going to be insurance companies or whoever claims that vehicle.
I see. Oh, okay. That makes sense.
Maybe if you're driving an untaxed, uninsured rust bucket and you want to get rid of it, you might be able to, but I don't know.
I still have the remnants of 1970s thinking lodged in my head where everyone's parents, mostly fathers, fixed their own cars. But now it's like, I don't want to get my hands dirty. I have no interest in that. Right. What's the third reason?
So the third reason is that Copart is a landowner. And we're talking about the comparison between Copart and IAA. Yeah. Copart owns between 80 and 90% of the land on which it operates in salvage yards. IAA is basically the exact inverse of that. I think it owns about 10% and leases the other 90%. So straight away, you've got about a $2 billion asset on the balance sheet rather than an expenditure, which is nice, obviously. But more so than that, you got the cost savings of avoiding new rental agreements every 5 or 10 years or whatever else. The landowner could get a better deal because, for something like a scrapyard, it's not going to be the most profitable use of land. Yeah. So IAA has to constantly maintain its entitlement over land for these scrapyards, whereas Copart has no issues there. Yeah. And then if it does lose its lease, the disruption to business that a relocation could cause as well. So there's seriously distinct advantages Copart has there. Yeah. And apart from that, it's got more scale as well in terms of acreage. So I wrote a stock of the month report on Copart in January of this year, which is available to Invest Plus users, and we talked about the difference in terms of scale but also how customers perceive that. So Copart has about 17,000 acres available to it. IAA has something like 12,000, but at times of high demand, like after a natural disaster is a perfect example, this really comes into play. So there was an exact example after Hurricane Harvey in 2017. It hit Texas and Louisiana. And so because Copart had that extra capacity and more control over the land it owned, it actually won over a major insurance from IAA because of this exact reason, where IAA couldn't satisfy the amount of scrap that came from the hurricane and the flooding and all the rest. So there's examples like that where you really see the difference between the two businesses, and that's why I wanted to give it specifically in terms of being a landowner. as its own separate reason. In that same interview with Leah Stearns, the CFO, she talked about the potential to reach 100% land ownership over time too. And we're talking about returns on capital and reinvestment opportunities. This business has managed to maintain 30% returns on capital consistently over the last 5 years and longer. Management clearly has this keen eye for those reinvestment opportunities, and the benefits of land ownership are clear to see. So we should be excited about this as a business, as investors in this business. So yeah, that's the last reason as well.
Interesting. And you touched on it there when you said they decided to go digital, as it were, way sooner than IAA. And in my mind, when I hear Copart, I think they've managed to take a really old world business and bring it in to the modern age with the most advanced IT systems. I saw once online their air traffic control, if you like. They have this kind of, I don't know what you call it, ops center, where they have just these big maps beamed up on the wall where they know every single part in every single location. So if a buyer in one state needs a part that's in the adjoining state, they get it over so fast. And that's really where they reduce the customer pain, where the buyer knows they need this carburetor for the big old Ford, but it's not in stock, but we'll have it to you within 12 hours. And that really is taking away customer pain, where they'll get it. It's like, we don't have it, but we'll get it for you. Sit down there and have a jug of coffee, and we'll have it for you soon. Right, so what's the main risk, Mike? What is it you dislike, or at least is there anything about it that you're cautious about?
Yeah, I talked about EVs as a potential boon in the coming years, but there's some question marks there too, in my opinion anyway. So with something as valuable as an EV battery out in the line, there mightn't be the direct salvage model in play as much. Maybe OEMs might bring about their own reacquisition programs. There could be other alternative salvage methods that arise, which might take the business away from Copart. So we know for a fact that the industry is set to go on some form of transformation. Now, I know EV adoption hasn't picked up the way people imagined in the States, but it does seem like some form of inevitability about however long that may be. We don't know. But for a company with such market dominance, it change usually isn't good. Do you know that kind of way? I still believe it's got plans in place that should come out on top, but it just does bring in some question marks.
I totally agree.
Yeah, if you want to talk big picture, you could also argue autonomous driving is a bit of a red flag for Copart. If it's as safe as it's purported to be in the crash per, or what is it, incident per 100,000 miles or whatever, goes way down in autonomous driving. Yeah,
that's a good point as well.
You could argue, but I don't think that's a concern for the next 40 or 50 years until we see wide scale adoption.
Yeah, you're right. There's a tendency you can over-index a risk, and I've always held that risk at the back of my mind for Copart, the EV thing, and in reality, is it eroding their business? Well, certainly there's no sign of it at the moment. And when it comes to, there's another, which is I suppose the cousin of the risk you raise, which is the depreciation characteristics of an EV are entirely different to a mechanical engine. I'd have to sit down with a crayon and a big sheet of paper for me to get my own head around it, because EVs depreciate like crazy. So what does that do for Copart's business? What does scrapping mean? Well, I think the redeemable value of an electric vehicle is the lithium ions that are held in its chassis. And what are you going to do with that? Look, my head starts to hurt when I try to start to consider it. I need to sit alone quietly and consider the whole thing. But I would say that's their number one risk. Autonomous and EVs as a shift, an innovative shift in the entire motor industry. That's the one that's sitting there, and it has to permeate itself into Copart's world. Yeah,
and you mentioned it actually at the start when you were looking at it forlornly. It's always been an expensive stock.
Yeah,
you're gonna pay a premium to own it. Yeah, so that's just worth considering as well.
Right.
Okay. Your second one is Axon, which is a very interesting business. So tell us a bit about it and why you invested in it.
Formerly known as Taser, actually. So I'd say everybody has heard of a Taser at this stage, but Axon would be less a household name. Taser, by the way, this is a by the way thing. It stands for...
It's an acronym, isn't it?
It is Tom A. Swift Electric Rifle. So it was invented by a guy called Tom Smith, who I interviewed on Horizon, by the way. So I interviewed the inventor of the taser, Tom Smith's electric rifle, and his brother Rick Smith runs Axon. And they basically now, what they're most famous for is tasers. And what they're
Rick does razors, but not those kind of razors.
And body-worn cameras. So our law enforcement agents are wearing body-worn cameras. I'm sure everybody has seen the footage in some form or the other. And then they also have software, de-escalation training, civilian products. But basically, Axon are the ones that are bringing the people keeping us safe into the next generation of technology.
Okay. So, in your opinion, what's the number one reason?
Okay, I'm going to go with it's rapidly expanding its market reach. That would be my number one reason. Even the police force here in Ireland, known as the Garda Síochána, are getting body cams, Axon body cams specifically. And I saw it on the news, the Irish news at 9 o'clock on the television, where I paused and moved in. You could see it was Axon's product and their logo was there to be seen. And when it's permeated right into this small island following a little bit of civil unrest last year. But across the water, Axon has forged a strategic partnership with the government of Scotland and so on. So there's an unmissable increasing demand for advanced public safety technologies, driven by, I guess, a worldwide focus on how our law enforcement agents are behaving. And also, it's a bit of a pity, if you ask me. I kind of like, I suppose, look, I won't air my own views. Pity cops can't just do it the old-fashioned way, but that's but anyway,
you talk about body cams and the importance. It's interesting anecdote, but any golfers will know all about it. Basically, mad stuff happened there, a golf tournament where the number one golfer was arrested. He was dragged out of his car before a tournament, but the big thing was the police officer turned off his body cam footage.
Oh, really?
And it completely, because no one knew it was a he said. Yeah. And there was all this consternation about it because that vital piece of technology was
really
not
so it moves into hearsay
as it should have been. Yeah.
Look, Axon is the Apple of the space, plain and simple. And their 20-year market opportunity is off the charts. And anyone who is in the law enforcement business, or indeed civil, like fire brigade and all variations of people who serve the public, they'll have an Axon product on their body in the next 20 years. I'm sure of it.
Okay, easy one there. All right, number two reason for owning an Axon.
I think I'll mirror Intuitive's. The second reason I gave for Intuitive Surgical and go with R&D, which led to the launch of the Taser 10 and the Axon Body 4 most recently. And like in the Body 4, for instance, their latest cam, there's a development of a two-way voice communication through the cameras. And their R&D expense was $91 million in the last quarter, which was just 20% of revenue. That's serious. Like, these guys are spending hard to stay in the front edge of what they do.
They need their own team just for acronyms, though, so that's going to cost a lot.
They do, exactly. So exactly. So I think R&D is the second reason. So they are the kingpin in a growing industry is reason number one, and reason number two is they're spending hard to make what they've got better.
And as a company that is leading a market, you love to see that R&D spend, because it's clearly, and similar to what we're talking about with the two businesses we've already seen, it's clearly already working.
Yeah, that's right. You know what I mean? That's right.
So it's only extending their advantage. There's a really interesting. I was researching Garmin, the fitness watches. Well, they do a lot more than fitness watches, but people will know them for fitness watches.
You're getting old. You told us all about Garmin in a recent podcast. I don't remember what I said on podcast, but I remember what you said. You told us about it.
But there's a brilliant slide in their investor deck when it shows the difference between R&D spending and sales and marketing spending. Yeah. And it's something like, I think they spent 20 more times on R&D than they do on sales and marketing. And their argument is that because our products are so much better than everyone else, because of all the research and development we do, we don't need to spend on selling it because word of mouth is enough.
Right.
You know what I mean?
Yeah. So, that's actually very interesting. Benefits. Very interesting for sure. All right, so that's how many reasons I give. I'll give a third one. I'm gonna go with a reason that I could have easily put down as what's going to go wrong, and it's the recent acquisition of Dedrone, which is a global leader in airspace security. So they announced in May that they were in a partnership. Oh, no. That acquisition was announced in May. And then earlier this year, they announced that they were in a partnership with a company called Skydio, which basically does drone software and makes it readily available for public safety agencies through Axon. But coming back to Dedrone, which they just bought, it specializes in counter drone systems, which are crucial for detecting and tracking and identifying and even mitigating unauthorized drone activity, which I think anyone listening will realize that that's a growing threat to everyone. If you see a drone fly over your house, it shouldn't be there. So just think of the need for that solution for the thousands, hundreds of thousands perhaps, of airports around the world alone. And then think of prisons, like drones flying over prisons. I was watching Mayor of Easttown on Paramount there recently, and in one of the episodes, the baddies in the prison were getting deliveries from drones. I mean, there's so many, I suppose, mal-uses of drones out there, are just kind of accidental uses of drones. It's unreal. So this acquisition from Axon is expected to close in the second half of this year, and it's part of Axon's strategic expansion into robotic security applications. And I think it's a great acquisition, and if they integrate it appropriately, I think it's an avenue for further growth.
Very nice. Okay, then, what are the risks involved?
I think it's that whenever a camera is introduced into a community, you're going to get a lot of feedback on public perception, mostly around data privacy concerns, and it's a human condition. So I think for each new market that Axon enters, it needs to deal with that effectively. I happen to like the thought of a police force that are in part walking cameras. Yeah, I mean, they have a tough enough job to do already, you know?
But it's interesting as well, you talk about this, obviously with the body cam footage, but now with the drone detection stuff as well. It's almost self-regulation, if that makes sense.
It is, though. Look, I mean, our police have a tough enough job to do, and I'm one of the people who likes to see them empowered with laws and empowered with investment and support and respect and everything else, because when the chips are down, if you really need someone to help, you want to make sure they're arriving with the best of equipment that they can serve their purpose.
But on the other end of that, I know you're talking from a very Irish perspective there, but on the other end of that, there are police forces that are notorious for having awful behavior.
That's true. And everything I have
this body cam footage is a self-check. It works inversely as well.
It does. And so everything I said in reference to Axon was coming from an Irish perspective, looking at our Irish police force. Of course, when I think of other police forces from around the world that have certainly exhibited some very unfavorable behavior and illegal behavior in some instances, that's not good enough. So everybody's kept safe with a body cam.
Yeah, big time.
Right, okay, let's go. What are we on? The fourth. Okay, so you're going to talk to us about a favorite of mine as well, which is Airbnb. So hit me up. I don't think you need to explain to people what it does. What's your first reason?
Yeah, everyone knows what Airbnb is. And this is a bit hotty or toddy. It's certainly more hotty toddy than Copart, for the reasons I picked it anyways. But we're talking about the world's top travel brand, and it's truly beginning to value, in terms of AI and working from home and how people's approach to work has become since the pandemic. We're a society now that's really beginning to value real world experiences more and more. And so with an AI future in mind, I think the first thing of what that entails, in a perfect world, we say, is a 4-day work week. Is that a fair statement? It's kind of. I think it's a very fair
statement. Yeah, no, I think it's a fair statement for non in the flesh jobs like cutting people's hair or whatever. Like, I think a 4-day work week is a trend for sure.
Yeah, in terms of what the production efficiencies AI can bring in any kind of office job, I don't think it's unreasonable to think that a lot of companies will move to a 4-day work week eventually anyways. I don't think it's an outrageous statement. Maybe it is. I'm
No,
not
I don't
sure,
think so.
but
Would I be right in saying the entire Finland gave it a lash for a while? There's one of the Nordic countries decided, okay, we're a 4-day work week country, and they gave it a shot, and there was some amazing findings. The BCG, Boston Consulting Group, researched the human efficiency by moving to a 4-day work week where people work a slightly longer day from Monday to Thursday inclusive, and then with Friday off, ultimately the business benefited. So I think we have enough data to support the point you've just made.
And so, like, even at the very least, what we're going to see is probably a continuation of working from home, distributed workforce, and the need for being in the office becomes less and less important either way.
Yeah.
And what working from home has done is just opened so many opportunities for people to reimagine how they work and live and travel. Like, I'm a prime example of this.
Yeah.
Like, I'm probably actually too close to this to give an unbiased answer, but I basically lived in Airbnbs for the last 2 years on and off.
Did you ever go to a different website? Did you ever go to a competitor?
No.
So they have
they're like,
total brand occupancy in your head.
Completely, and we're talking about marketplaces again.
Yeah.
And Airbnb has all we call it liquidity, the options for both buyers and sellers.
Yeah.
It's very much a no-brainer. Obviously, there's going to be more niche places in certain locations and all the rest, but on a global scale, there's nothing close.
Yeah.
And that digital nomad lifestyle has become more and more reality for a lot of people, and it's turned Airbnb into a lot more than just a hotel alternative. It's basically turned it into the world's biggest landlord. So long-term stays of 28 days or more now account for about 17% of total nights booked.
Wow.
And that's grown at 25% year over year. If you think of how many nights, I think it might be 100 million a quarter, give or take. Do you know what I mean? So 1/5 of that is basically people living on the platform in some shape or form. And we're talking about marketplaces and the network effects on a global scale Airbnb has, but there's also the peace of mind you get from booking with a brand like Airbnb rather than a local operator you don't know anything about when you're heading to a foreign country. And that really can't be overstated, especially with longer term stays where there's a lot more money at risk. Do you know what I mean? So for the world being able to travel more and the growing need for that real world experience, especially if we're cooped up at home when we're working, I'm picking the world's largest and most trusted travel brand, and that's Airbnb. It has detractors, and people have had bad experience on it. Same with any kind of company at this scale. It's going to happen, but I believe it's a fantastic business.
Yeah. Okay. Here. What's your second reason?
So this one's a bit more boring, but probably maybe even more important. That's just cash. So in the last 12 months, the company's taken in $4.2 billion in free cash flow, took in $1.9 billion in Q1 alone.
Wow.
And this transformation to its balance sheet has happened really, really quickly. Obviously, 2020 is such an outlier. So we kind of skipped past it. I think it was a 3.5 billion quid outflow of cash in 2020. But if you go back to 2019, free cash flow was negative 800 million. In 2021, it hit that travel rebound after COVID and came to about 600 million. 2022, it tripled to 1.8 billion. Wow. And then 2023, it pretty much doubled again to 3.5 billion. So I know you like describing graphs, Emmet, but that's a pretty simple one. It's up and to the right, and it's very high.
Yeah. Even I got
so
that.
Its free cash flow margin at the minute is 41%, which is just top of the line, best in class for any business, software or otherwise. So yeah, this means it's currently sitting on an $11 billion cash pile right now, which can earn a nice 4%, we'll say, in money market funds. Not only that, but it's actually got $9 billion in customer funds, which can also earn a short-term interest on too, which is just a little cherry on top.
Yeah.
So what it's doing with that cash flow, it bought back $2.5 billion worth of shares in the last year. It's got a further $6 billion authorized. So it's weird. Like, this company went public in 2021.
Yeah. I think it was 2020. I'm just thinking. Yeah, exactly. 2020.
It's a very young company.
Yeah.
And it's already operating like a much more mature business. Like, long term, that share cannibalism that we've seen companies like Apple do so well over the last decade. Yeah. Continues to do that over a 10-year period, a 20-year period.
Yeah.
It's going to be unbelievable. So that's my second reason for for owning
It's
Airbnb.
basically got a fire hose of cash going into that. I totally agree. I mean, with Airbnb, there's only a handful of companies in your life you see grow very quickly into what I would affectionately refer to as an American icon, like Ford or Coke or indeed Meta. But Airbnb is one. Airbnb's brand, the fact that it has total dominance of you, someone who I would hold up as a very regular traveler, you don't even consider anything else. Would you consider local hotels when you go somewhere?
And I would maybe for short-term stays, if you're going for a hotel, you look at booking. But anything longer than, I'd say, 3 days, it's Airbnb all the way for sure.
We're Airbnb for our summer vacation this year. It's Airbnb all the way, and we're seasoned Airbnbers. Right, what's the third reason?
Another boring one, but probably equally as important, is just its current valuation. It's sitting at just under 20. I think it was 19 point something last time I checked.
Couldn't agree more.
That could change depending on the day. But in terms of what we outlined, mega brand, long-term secular trends, complete cash cow with unbelievable margins, and you're getting that for all under the market multiple. I think the S&P 500 is somewhere between 22 and 25 depending on the day. That's just a no-brainer. I don't see its valuation staying in the teens for too long, to be honest. So that's a quick one, but a very important one, especially looking at right now the state the company's in.
Risks. What's the primary risk that you identified?
Regulation. It's the obvious one. It's an overarching theme that will probably always follow Airbnb in some shape or form. It's become a very easy target for politicians across the globe. We see it everywhere. To pile in as a straw man for, which in fairness, the multiple housing crises that are happening everywhere. Ireland, obviously, we know all about it, but it's happening all across the globe. It's becoming a very much limited asset housing, and Airbnb doesn't help issues. I'm not going to sit here and say it doesn't, but it's far from the root cause. So that's definitely a major concern. But in terms of what did you talked about over indexing a risk just because it's there, and I think you might be able to do that too. Like New York is a good example. So New York brought in what essentially amounted to a blanket ban on Airbnbs. There was very specific reasons. Sorry, I shouldn't say Airbnbs. I should say short-term lets. But there is very specific criteria which could still allow people to short-term let, but it basically outlawed a lot of it. 99%, I would imagine. And New York is one of the most visited tourist cities in the world.
I think New York and Paris are the two hottest zones for tourism.
I know Paris is number one anyway, so I think I'm going to give New York the top spot. But we've seen that what is essentially a blanket ban and barely a blip to Airbnb's numbers. Do you know what I mean?
I wasn't aware of that. I mean, you do know there are cities that Airbnb are under attack, if you like, from policymakers and local government. New York is. I have Barcelona in mind. I know something happened in Barcelona as well a few years ago, and I agree with your risk analysis. I think local policy is there a little bit like Axon, perhaps. Is there a risk?
But I think with the New York situation, it shows just how diversified it is in terms of locations as well. And it's funny because what that also led to was, like, surprise, more expensive hotel rooms in New York.
Amazing.
So you're talking about people and cities that are entirely dependent on tourism. You can't take it too far, I believe, as well. So regulation, I think, will always be a reason not to invest, but I don't believe it breaks the investment thesis, at least for me anyway.
Totally. And they have a lovely, I suppose, side hustle called experiences, where if you're in a city and if Airbnb are blanket banned, you're slap bang middle of Manhattan, you can still open the Airbnb app and find dozens or hundreds of experiences. You could go and learn how to cook with a local chef in the kitchen, or you could go walk micro pig with red wellies around Central Park, or like whatever you're into. Like they have all these.
Exactly what I was thinking. Right.
Who doesn't want to walk a micro pig with red wellies around Central Park in the rain? But it's it offers unique experiences. And a couple of years ago, John Tyrrell, my co-friend, and I were down in Sydney, and we just fired up Airbnb. We ended up in the kitchen of the most prestigious steakhouse in Australia, with the head chef throwing food at us for pennies on the dollar, where otherwise we would have, if we were sitting out the front with all the other flutes, we'd have had to pay hundreds of dollars, but we're in there with the cut and trust, and it was absolutely brilliant. It was amazing. So yeah, you get experiences too. All right, okay, so that's it, Mike. Is that, have we done 4?
We've got 2 each, yeah.
Great.
Intuitive Surgical, Axon, Airbnb, and Copart.
4 amazing businesses. They're all there's 4 desert island stocks for you, Mike. I mean, if you were to say a hyper concentrated of a portfolio of 4 businesses that in all likelihood, in my opinion, will outperform the market index, I would say you couldn't go far wrong with those 4. And AI, you know, that might aid it, might get a few pinches here and there from AI, but they do stuff in the real world. You know,
real world is the big thing. Yeah, and we talk about moats. Moats is a very common theme amongst them 4 as well.
I mean, you just, when you run the AI gauntlet over those 4 businesses, you can see areas where the business model might be tweaked, but you certainly don't see it being destroyed by AI.
Yeah, absolutely. Okay, that was a fun show. I like doing something a bit different.
Yeah,
we'll probably get back to the newsy more updates, but I think we can definitely fit in a couple of these every few weeks.
Maybe a Micropig spin-off. Micropig and Red Welly spin-off.
Maybe that's where the business goes, is sourcing those red wellies from Micropigs. Right.
Hey, we'll go wherever we need to.
Thank you.
All right, Mike.
Joining me today, and thanks everyone for listening in. That's it for today's show. Remember to hear more about the launch of Vodafone Business UC with Ring Central. For organizations of all sizes in Ireland, just click on the link in the show notes. Or if you want to see more details in your email, sign up now at MyWallSt.com. Also a reminder, we're doing loads of stuff. But actually, I think for this show, Invest Plus is your best bet, because we've got some brilliant write-ups. Copart is one of them for our Stock of the Month pick, and we might have a new one coming up in July that was mentioned on the show as well. So Invest Plus is a great place to go if you're interested in this kind of content and you want to get your monthly email of a very detailed write-up of one of these stocks in your inbox. Thanks for joining us today, and we will talk to you next week.